Hi, hey Facebook world. How is everyone doing this wonderful, glorious 90-degree evening? Hope everyone's doing well. It is May 28th, 2019. For those of you who don't know me, my name is Kash, and I am the accounting consultant attempting to bridge the gap between CPAs and small business owners. One of the ways I'm attempting to do that in 2019 is to come on live every single day with a tip, a tidbit, or some food for thought. This week we have been diving deep in our accounting 101 lessons with revenue. So today I wanted to come on very quickly to basically just say this. Keep in mind, revenue minus cost of goods sold equals profit, okay? Not net profit, it equals profit margin. Okay, what is cost of goods sold? Quite simply put, it is money going out of your company so that you can produce a particular product for sale. Okay, let me say that again. It is expenditures or money coming out of your company specifically for items that will be resold. Okay, maybe they are items that will be put all together in order to make a finished product, which will then be resold. That falls into cost of goods sold as well. Maybe it is materials, maybe it's supplies, maybe it's subcontractors, maybe it's salary. Okay, there's lots of different things that can fit into cost of goods sold. It is different than expenses. It's different because these are pieces of the puzzle that we have to have in order to produce the thing for sale. Okay, so if you're making earrings and you're making earrings out of polymer clay, right? That clay is a material, it's a cost of goods sold. This comes into play heavily when you are holding inventory or when you're making a product. Doesn't come into play so very much when you are selling a particular service, but it can still come into play. Maybe it doesn't happen as often, but your particular case may be that you do have some cost of goods sold. So keep in mind that your top line revenue is not actually simply the cash that's coming in or cash that people are paying for your product and service. Ultimately, it's just the first piece. The next piece is your cost of goods sold. You must take that into consideration. And why that's so incredibly important? Two reasons. One, generally the cost of goods sold is going to determine what your sale price is. Okay, so it's going to determine what your profit margin is or what your product margin is. That's the first reason that it's incredibly important. And the second reason it's incredibly important is because if I had to spend $5 in order to make $6, I didn't really make $6. I made $1, right? If I had to spend $5 in order to acquire the product that I then turned around and sold for $6, ultimately I only made $1. As you can see with this very simple example, there's a lot of things that can happen if you're only looking at the $6 and thinking that you made $6 when in reality you only made $1. Okay, so it's actually a very, very powerful piece in this whole revenue stream, in this whole income stream, when you're talking about small businesses. Okay, so that is my Tuesday tip from me to you. Thank you guys so very much for joining me, and I will see you tomorrow for my Wisdom Wednesday tip. Bye.